Every major institution on Wall Street is running the same models right now, and they're all quietly converging on the same window of time. Not a vague warning, and almost none of them are willing to put a date range on television. Because the moment a major bank says recession, mid-2027, it stops being a forecast and starts being a headline that moves markets. So they whisper it in research notes instead. Today, I am going to do what they will not do on camera. I'm going to show you the exact convergence of data that points to a specific window for the next US recession. And I'm going to show you the one mechanism that is currently hiding it from you. Stay with me. Because by the end of this, you will understand why is a recession coming was always the wrong question. On this channel, we do not do panic and we do not do cheerleading. We follow the logic of power. We follow the incentives. And when you strip away the emotion in the headlines, the picture always becomes clear. Here's my thesis. I'm going to show you exactly 3 things. First, the American economy is not slowing down. It is being held up artificially by a single sector, and that sector has never held up an entire economy before. Second, underneath that support beam, the actual foundation, the household balance sheet, is already cracking in ways that are structurally identical to every recession since 1955. Third, when you line up the timing mechanisms embedded in 5 separate indicators, they do not scatter randomly, they cluster. And that cluster gives us a window nobody on financial television. Let me start with the facts, because you need the ground beneath your feet before I take you into the analysis. We are in the middle of 2026. Unemployment sits around 4.4%. GDP growth is projected at roughly 1.8% to 2.2% for the year. That is below the 2.3% average. This economy has run for the last 2 decades, and the direction is down, not up. Inflation, meanwhile, is not cooperating the way a slowing economy is supposed to make it cooperate. The Fed's preferred inflation gauge is tracking toward 2.7% by year end, with the core reading already above 3%. That is not an economy that is merely cooling. That is an economy that is cooling and still running hot at the same time, which is the single most difficult combination for a central bank to fix, because the tool that cools inflation is the same tool that kills growth. Economists have a term for the underlying pattern. They call it stall speed. The plane is still flying, but barely, and it no longer has the altitude to absorb turbulence. That explanation is too simple though, because stall speed alone does not tell you when the wheels come off. To understand the timing, you first have to understand what is actually propping this economy up and what is actually breaking underneath it. I want to introduce you to a concept I call the deferral engine. Think of it this way. Imagine a household that is falling behind on its bills. So it opens a second credit card to pay the minimum on the first one. From the outside, everything looks fine. The payments are being made. The lights are on. But nothing has actually been fixed. The debt has simply been moved into the future, and it is larger when it arrives there. That is what is happening to the entire US economy right now. Except the second credit card is not consumer debt. It is roughly $1 trillion a year in AI infrastructure spending, data centers, chips, power grids, all of it landing in the GDP numbers as investment, all of it currently the single largest driver of American growth. The deferral engine is not fixing the economy. It is borrowing time from a future in which that investment either pays off or does not. Now let me show you what the deferral engine is covering up. Layer 1, the obvious evidence. American households are carrying $18.8 trillion in debt, roughly $4.6 trillion more than before the pandemic. Credit card balances sit near an all-time high, and inside that number, about 13 cents of every dollar is more than 90 days past due. I want you to hold that number in your head. 13 cents on the dollar. Seriously delinquent. The last time credit card stress reached that level was 2011, while the country was still climbing out of the wreckage of the Great Recession. We are sitting at Great Recession aftermath numbers in an economy the headlines are calling healthy. Layer 2, the hidden evidence, the part almost nobody outside the data actually sees. Auto loan delinquencies have just hit their highest level ever recorded. Student loan delinquency has climbed past 10%, the worst since payment pauses ended. And when you split the household debt data by income, you get what analysts call a K-shaped economy. The top of the K, upper income households with strong balance sheets, is fine. Genuinely fine. The bottom of the K is quietly breaking, using credit cards averaging over 21% interest, not for vacations, but for groceries and rent. That is not discretionary borrowing. That is survival debt. And survival debt has a shelf life. This matters enormously because consumer spending is roughly 70% of US GDP. When the bottom of the K runs out of borrowing room, that 70% does not slow down gently, it shrinks. Layer 3, the connective evidence, the piece that links everything together in time. The yield curve, the gap between short-term and long-term government bond rates, inverted in 2022 and stayed inverted for an unusually long stretch. It has inverted before every single US recession since 1955. Every single one. But here's what almost nobody explains correctly. The inversion itself is not the recession signal. The recession historically arrives 12 to 18 months after the curve uninverts, after it steepens back toward normal. That re-steepening began in late 2025. Do the arithmetic with me. Add 12 to 18 months to a re-steepening that started in the fourth quarter of 2025. And you land in a window stretching from late 2026 into the middle of 2027. That is not a coincidence. That is a clock, and it has already started ticking. Layer 4, the numerical evidence that makes this undeniable. The Conference Board's leading economic index, a 10-component gauge built specifically to look forward rather than describe the present, has posted negative 6-month and 12-month growth trends for over a year now. A sustained negative trend in that index has preceded every modern U.S. recession. And the lag from that kind of contraction to an actual downturn typically runs 6 to 12 months. Layer that onto the yield curve math, and the window tightens further, centering on the second half of 2026 through mid-2027 as the period where the underlying economy loses its footing, with the actual downturn most likely confirmed somewhat after that as the data catches up to reality. Let me give you one more piece of this, because it is what makes the AI spending story more than just a side note. There is a structural feature of this investment wave that should make you uneasy on its own. A meaningful share of the capital flowing through the largest AI companies is circular. One firm invests in another. That second firm turns around and spends a large share of that money buying computing capacity from the first. On paper, revenue is being generated. GDP is being counted. But strip away the accounting and ask a simpler question. How much of this is new demand from outside the system? And how much of it is the same dollars moving in a loop, each pass through the loop showing up as growth? We have seen this pattern before in a different infrastructure boom a generation ago. And the lesson from that earlier cycle was not that the technology was worthless. It was that the financing structure around the technology outran the revenue the technology could actually generate. And when the financing cracked, it took years of investment down with it, regardless of whether the underlying innovation was real. I am not telling you the AI story ends the same way. I am telling you the deferral engine and the circular financing question are the same risk wearing two different names. And separating them from each other is a mistake almost everyone watching mainstream coverage is currently making. So let me draw the distinction sharply. This is not a healthy economy carrying a temporary AI boom. This is a fragile economy being kept vertical by one investment wave, while the load-bearing wall underneath it, the American consumer, is already failing a stress test in slow motion. Now, before I continue, I want to present the strongest possible argument for the other side, because I owe you the real debate, not a simplified version. The optimists have real numbers behind them. Credit card debt is only about 7% of total household debt. Liquid assets among upper-income households remain historically strong. Household debt service as a share of income is still below pre-pandemic norms on average. A well-known recession indicator built by a former Federal Reserve economist which flags danger when unemployment rises meaningfully off its low, currently sits well below its trigger threshold. Prediction markets are pricing the odds of a 2026 recession in the low double digits. This is a serious case, and I want to be fair to it. It describes 2026 accurately. It does not describe 2027. Averages hide the K-shape. A recession indicator built on unemployment cannot see stress that is currently showing up in debt delinquency rather than job losses, because right now the labor market is being propped up partly by a separate factor, a sharp slowdown in net migration, meaning fewer people are entering the workforce to be counted as unemployed in the first place. Strip that distortion away, and the labor market underneath is considerably weaker than the headline rate suggests. The steel man describes the surface. It does not describe what lies beneath it. So here's the part you actually came for. What is the most credible window when every timing mechanism is layered together, not cherry-picked, all of them at once? The yield curve re-steepening points to late 2026 to mid-2027. The leading economic index's sustained contraction points to a very similar band. Multiple major forecasting models, when they build out a downside scenario in which AI investment gets reassessed once companies start demanding measurable returns they are not currently getting, land at reassessment specifically in 2027, with growth and employment metrics deteriorating further into 2028. When independent risk analyses model what an AI investment slowdown could do to equity values, the number is measured in the tens of trillions of dollars. And the timing they attach to that risk sits in the same 2027 to 2028 band. 4 separate methodologies using 4 separate data sets built by people who do not talk to each other, and they converge on the same 18-month stretch. I want you to memorize that window, mid-2027 to early 2028. Write it down. Come back to this video when we get there and tell me whether the data held up. I want to be direct about geography for a moment, because geography is where the truth always lives, even in a story that looks purely financial. This is not only a domestic American story. The oil price shock tied to the Strait of Hormuz disruption earlier this year is a reminder that the inflation side of this equation is not fully in America's control. At a closed shipping lane and a spike in energy prices, and that 3.1% core PCE number I asked you to remember stops being a stubborn statistic and starts being a floor, the Fed cannot easily cut beneath. Every one of the models I have walked you through assumes a roughly stable geopolitical backdrop. Remove that assumption and the window I have just given you does not shift later. It shifts earlier. But there is one variable that could move this window, and I want to be honest about it rather than pretend the picture is fixed. The Federal Reserve. If it cuts rates aggressively, and those cuts actually reach households through cheaper borrowing, the runway extends, potentially pushing the reckoning into late 2028 or beyond. But the Fed is walking a wire. Inflation is still above target. Cut too fast, and inflation reignites. Cut too slowly, and the stall speed economy loses what little lift it has left. As of right now, rates have been held unchanged, which means the pressure underneath continues building rather than releasing. Here are my 3 predictions, numbered and specific enough that you can hold me to them. Prediction 1, sometime in 2027, at least one of the major AI spending companies will announce a meaningful pullback or delay in previously committed data center or infrastructure spending. And it will be framed publicly as capital discipline rather than what it actually is, which is the deferral engine running out of runway. Prediction 2, consumer credit delinquency data, particularly in auto loans and credit cards, will continue climbing through the back half of 2026, even as headline GDP stays technically positive, because the K-shaped divide will keep the top of the economy propping up the average. Prediction 3, the absence prediction. Watch for what does not happen. Watch for the Fed not to cut rates aggressively through the remainder of 2026. That inaction, that silence, is itself the signal, because it tells you the inflation side of the equation is winning the internal argument, which means the growth side absorbs the cost. 3 things to watch going forward. First, the yield curve's re-steepening pace over the next 2 quarters, because if it steepens faster than expected, the recession window could pull forward into 2026 itself. Second, the delinquency data in the New York Fed's household credit reports, because a sudden jump rather than a slow climb would tell you the bottom of the K just hit a wall faster than the models assumed. Third, quarterly earnings language from the largest AI infrastructure spenders, because the phrase to listen for is any mention of return on investment timelines, which is corporate language for the reassessment this entire thesis depends on. Every empire, every boom, every bull market has believed, right up until the moment it ended, that this time the support beam was permanent. The people who lost the most in past downturns were rarely the ones who lacked warning. They were the ones who had the warning and treated it as noise. So the question I want to leave you with is not whether a recession is coming, because recessions always come and they always end. The question is whether you will still be treating the Defoe engine as strength when it finally runs out of runway, or whether you already understood, watching this, that borrowed time is not the same thing as solid ground. The missiles get the headlines. Deferred debt sends the bill. This story is going to move fast over the next several quarters, and I will be tracking every data release as it comes in. Tell me in the comments which of these 5 layers, the debt data, the yield curve, the leading economic index, the AI investment cycle, or the labor market distortion worries you the most and why. I read your responses, and your questions shape the next analysis. If you want the full breakdown of how to actually prepare a household for this window, not theory, but the specific moves for debt, cash reserves, and asset allocation, I put all of it in the Crisis Preparation Blueprint. The link is in the description. I'm Professor Jiang. Thank you for watching.